Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. Hey, everybody. Welcome to the 6th edition of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we've made it to 6. That's kind of amazing, isn't it?
That's huge. Been getting some good reviews, too.
Well, that was your aunt, wasn't it?
Well, my sister-in-law, an aunt, a friend in London. It's worldwide. It's happening.
We'll take all the positive reviews we can get, but we're going to have some fun this week. I mean, believe me, the stock market continues to struggle. There's lots going on. This week we're going to have a playful theme along Halloween. We're calling it "What is Spooking Investors?" And behind me, I've got a little bit of a set. I've got a skull, and what else do I even have? Got like a little pumpkin and a little thing my kids made for Halloween. So we're going to talk about what's scaring some investors. We're going to talk, Sonu, this week, obviously, about all the volatility, right? The stock market volatility we've been seeing, maybe a little bond market volatility. Then inflation, right? That's a big fear that's obviously scaring investors and just your average person. Prices are staying high. Are they coming down? Yes, not nearly as much as we'd like to see. And then we're going to end it up with a little economic discussion focusing on our friend Jamie Dimon, as he seems to be extremely scared about some things going on out there. So, Sonu, before we start, it's Halloween season. You a Freddy Krueger guy, Michael Myers, Jason? Who's your Halloween scare movie star if you had to pick one?
Oh,
didn't see this coming, did you? I got you.
No. Mike Myers and I still have to get into that with my kids. Baby, we did put Halloween decorations out this weekend in the front yard, so that was fun.
Yeah, so I did just move. We've got some Halloween decorations out front. It rained. Of course, I blew a bunch of fuses in a new house. I had no idea where the fuse box was, but eventually I got there. So anyway, that's enough about that. So the volatility is just crazy. I mean, we're going to talk. So Thursday, right, we had the CPI number came in higher than expected. We're going to talk about all that. But we had a huge rally, a 5% rally off the lows on Friday. Then on Thursday. Then Friday had a vicious sell-off. Stocks are sold off 5 Fridays in a row with some huge sell-offs. And at least the time we're recording this on Monday, we've got a big bounce. If you talk about, a seesaw market as we continue to flirt with 52-week lows, that's just, a piece of it. I mean, why in the world do you think we're having so much volatility right now, Sonu?
I mean, the CPI report was the day that came out, right?
Yep.
It was interesting because if you followed, so even before the market opens, there are futures, instruments, derivatives that trade based on what the market will do, right? So before the inflation report was released, which happens at 8:30 Eastern time, markets are positive about that because I think everyone expected, numbers are going to be soft, and that's going to lead to the Federal Reserve easing up on interest rates. And the numbers came in. It was hot. It was harder than expected. Numbers were, plainly put, it was a bad report, right? Mm-hmm. Futures tanked about 2.5% after that. It was down. The market for the S&P 500, the futures are down 2.5%. And then the market opened at 9:30 Eastern. It opened about 1.5% below, and then finally closes the day at 2.5% positive return. Like you said, a 5% up move, right? Which is huge.
We like roller coasters, but I don't know if we like roller coasters quite like that. That was something. I mean, yes. Again, I took a look, right? So we were down 5% bounce from the lows, where you finished 5% higher from the lows last Thursday. You look back in history, Sonu, that's really rare. Not saying probably people don't realize. When you look at the times that's happened, March 2020, late December 2018, March 2009 were the last couple times we've seen a volatility like that, positive volatility. And you think about it, I mean, just Thursday, just put yourself back in that, it's facts versus feelings. How were you feeling last Thursday? Okay, I wasn't feeling very good. I don't think anyone was. That number came in hotter.
It's feeling awful.
Yeah, markets just tanked again. You're like, oh my goodness, here we go again. You want to talk about potentially a capitulation low where there's incredible fear, people just giving up, right? And that's, as terrible as that feels, that can be what it takes to make a bottom. And you hear some of those other days that we saw. Now, I didn't even know we go this route, but what was fascinating to me, remember our crowd here, so I got too geeky with this. There's something called the VIX Volatility Index, right? If the VIX goes higher, that means there's more fear in the market. What shocked me is Thursday morning, market down like 2%. I looked and the VIX was like flat to a little bit lower. to me, again, keeping this fairly simple, you would assume to be a big spike higher, but maybe the options market was saying, you know what, we're not buying it, and we think there could be a rally. And sure enough, that came in. So that stood out to me a little bit as well. Anything else on Thursday that stood out to you on the rally? Then we'll kind of talk a little more about Friday, how we sold off afterward.
Yeah, it's interesting that, look, we got a bad economic data print, right? Bad, and and bad because, yes, inflation's been high. So it's not like that's new news, obviously. And we'll get into like everything that's underneath the headline there, right? But it's bad in the sense that the Fed's going to look at it and say, oh, we're going to raise rates. And nobody likes that. And the market certainly, reacted to that, at least initially. But I was going to ask, is it a good sign, focusing on the positive here, that bad data did send the market lower, but it couldn't really stay there, right? Or break even further to new lows?
No, it's a great point. I love the idea about new lows and what's going on. On June 16, that was like the low, right before we had the 17% rally. If you guys remember the summertime rally, June 16 lows, about 200 stocks in the S&P 500 made a 52-week low. That's a lot of stocks breaking the new lows. Keeping this real simple. Just last week, we kind of went beneath the S&P 500. It broke those June lows. We only had like 100 stocks make a 52-week low. What in the world does that mean? Wow. That means less stocks are making new lows. Let's keep this real simple. Less stocks making new lows, yet the overall index was. That's a positive sign. There's a thing called a bang and whimper. It's kind of what we use in technical analysis, right? The bang is the June lows and kind of the whimper. And that's exactly what we're kind of seeing here, where you can carve out a potential low with less stocks making new lows. And again, looking at the stocks above their 50-day moving average, not as many as we had back in June. The 200-day moving average, not as many at the 200 days back in June. Again, a little more participation. My take is, listen, it was ugly, no question. But technology and communication services are huge parts of the market, and they are doing quite poorly. It's almost masking. There's industrials have held in there. Small caps, one of my favorite groups, not favorite groups, one of my more bullish indicators, I should say. We do like small caps. Small caps didn't break those June lows, right? Healthcare has been hanging in there. You've got some signs of some potential positives that are taking place, and not just the market making new multi-year lows. I think investors need to remember that, right?
And it's interesting that you think about, we look at a lot of macro data, like headline data, inflation, employment, all of that, to see, okay, that's going to tell us whether we are in a recession or we're going to be in a recession. But you can do the other side too. Look at stocks, right? Or those baskets you were talking about. Look at small caps. Look, if you're in the middle of a recession, small stocks are not going to be the ones that are doing well. And you think about industrial companies, right? Again, these aren't companies you would think would be doing well if you're in the middle of a recession or close to it, right? Regional banks is another one.
Yes, on like a relative strength basis. So look at how they're doing versus the S&P. Regional banks have been strong. Industrial's been strong. Healthcare has been strong. So I think, and small caps, I think it's a real easy way to put it. Industrials probably wouldn't be one of the stronger groups the last couple of months if we were truly heading into a massive recession like a lot of people think. We don't think that. When you look what the market's saying, maybe Mr. Market's voting that way. Final thing on this, we'll talk more about feelings, right? Facts versus feelings. The facts are the market's been ugly. The feelings are sentiment, right? I mean, we've had huge put to call ratios, meaning again, options markets are very worried. We've had, just anecdotally, right, how people are feeling. Sentiment polls are showing some of the most bears we've ever seen, some of the least polls we've ever seen historically, in line with some major lows, March 2009, March 2020, February 2016. These are all some potential positives as we're kind of getting the washout phase. And believe me, the market's not just going to make a new low and it's going to be obvious to everyone. That's why on Friday we come in and sure enough, sold off really hard, right? I think one of the things I want to see, one of the things I want to feel, right? I want to see some confidence in the market. So 5 straight weeks now, Friday's been down. And it's not like it's just been down a little. I mean, there's been some selling coming in on Friday. And again, I think it's as simple as that's an indicator to me that people don't want to hold over the weekend. I mean, do you think there's something there? Maybe people
I was going to ask you,
confidence to hold?
Right. Is that a thing, like something you'd like to see that, like consistently over time over the next few weeks? Fridays are not as negative anymore. And like you said, people want to hold into the weekend.
I think the answer is yes, right? I think there is some type of a sentiment there. And by the way, next Friday is my son's birthday, Sebastian. He might have been the guy who drew the pumpkin behind me there. He'll be 12 years old. So, we need some green. And by the way, my birthday is October 28th. So that's in a couple Fridays. So we better be green.
You're getting a lot of good feelings coming.
Yeah, I'll tell you. We'll see. We'll see. But anyway, so I think it's, it's one that it just, makes sense that you want to see investors want to hold over the weekend. And believe me, there's a lot of reasons to not want to hold over the weekend. That's why there's so much so many jitters out there. But again, that's a potential positive. Spooking investors, if you will, to stay with our title that we're using here. So good discussion there. Again, let's wrap it up like this. Talked about this last couple of weeks. 6 of the last 17 bear markets ended in October. Right, we've got some potential positives on the technical front. We've got some seasonality coming in play. We've got a lot of fear. It doesn't mean a bottom has to happen immediately, but we'd say expectations are extremely low, and we are likely carving out a potential bottom. Oh, one more final thing. If you look at that whole big 120% bull market that we had off of the COVID lows, right, March 2020, a 50% correction is 3,500 in the S&P 500. That's right where buyers aggressively stepped in last Thursday. And again, that's just a technical thing, but 50% retracements, what we call it, is an area that it makes sense that some buyers are going to step in. And fortunately, at the time we're recording this on Monday, that looks like what has happened. So, Sonu, we'll let you talk a little bit here about what scares us. So, I didn't answer my question. I always liked Freddie. I thought Freddie was kind of funny, right? He had a personality, you know. It's not like Jason's cracking jokes, right? I think there were maybe some jokes Jason did over the years, but yeah, and Michael Myers, I've never seen that guy be funny in my life. But anyway, I always liked Freddie for his personality. Maybe I'll do a Freddie claw maybe in a couple weeks on Halloween on this show or something. But anyway, so that's who I liked. But CPI, maybe
you'll have you do an impression.
I don't know. Yeah. Well, I got 2 weeks to work on it, right? Anyway, we'll see how that goes. But so CPI, let's get to it. I mean, investors are scared. You're average person, your average consumer, scared, spooked, whatever you want to call it. I mean, Sonu, that CPI number, we hinted at it, came in hotter than expected again. Not by a ton, I don't think, but still hotter than expected. Can you break it down from a services and goods point of view? Kind of what did you see under the as you peel back that onion?
Yeah, there's two pieces to it. One is, when you talk about what scares all of us, right? And then what scares investors specifically, right? What scares, like, nobody likes high prices, right? But then there's a question as to, is the government actually measuring it the right way, right? Is the prices you're paying, are they the same prices I'm paying? Are we buying the same things? Yeah. And, even the consumer price index, you take it, the largest piece of it is something called owner's equivalent rent, right? It's the rent that the government says homeowners pay to themselves. Nobody's paying that. I know you just bought a home. I own a home. You're not paying that owner's equivalent rent, which is 20% of the consumer price index basket, right? So it goes to sort of like, wait, why does CPI matter? It matters to investors now because the Fed is looking at it, right? And that's where, the feelings related to that, number come in. Look, the three big storylines there, right? One is energy dropped, right? But it didn't drop as much, energy prices, I should say. It didn't drop as much as it did in July and August. So it didn't drag. It didn't create that deflationary force as much as it did over the last few months, right? So it wasn't a big surprise. We know oil prices have stopped going down a lot, right? And it's going to probably start, adding back to headline inflation in October and November. So that's not going to be like what I call a positive tailwind anymore, right? Then services inflation, just too high, right? And a big part of that is rents, right? And then goods inflation. Yeah, we've talked about used cars before. We're seeing supply chains improve. We're seeing all of that. Apparel prices are being discounted because inventories in stores, you talk about Target, Walmart, all of them saying we're discounting apparel prices, right? But we're not quite seeing that in the official numbers yet. It's crazy. You're seeing falling prices everywhere or indicators for that, but we're not seeing any of it in official inflation data yet.
Yeah, I've said before, the 10 most dangerous words, President Reagan, right? Hi, I'm from the government, and I'm here to help. Almost like you can't trust some of the government data. We'll get into that. But just, again, some core concepts that you just pointed out. Speaking of core, I must have that in my head, because the core CPI came in year over year up 6.66. Right, you can't make that up. Remember the March 2009 lows, and the S&P bottomed at 666. That's, again, a 40-year high. You mentioned services. So services ex energy up 0.8%. That's a 40-year high. What other thing? Rent prices up 7.1%, highest since 82. What else do I have here? Health insurance. It's up 2.1%. Medical services up over 1%. The truth, again, it wasn't just one area. Even goods, right? I mean, because like you mentioned, like used cars, we've got the Manheim used car index
Yeah.
that dropped. It's dropped significantly. Yet then you look what that's a private company looks at that. Then you look at what the government's saying, and yeah, used car prices was down a little bit. They weren't down as much as people wanted. So it really was kind of I don't know how to put it, just a clunker of a report. Now the market did react positively. I mean, there you go. Yeah, you like that. But I mean, let's talk a little more about that. Why, I hate to say why we can't trust the government, but the government saying one thing with used cars, where you see in others, right? Medical prices are one thing, rents are another. Talk to me a little bit about how in the world we're getting different opinions, if you will, specifically, I guess, on rents right here, Sonu.
Yeah, rents is a good one to pick up because, we talk about it's core inflation. Core is basically inflation once you strip out food and energy, because this is a concept the Fed puts out because they say, food and energy are very volatile. We don't want to be chasing these prices, food and energy prices, up and down, as the case may be. Of course, over the last year and a half, everything's been volatile, but set that aside, right? So rents make up about 40% of core inflation. And that's actual rents, which people, renters pay, plus the rents, which presumably you and I are paying to ourselves, right? So look, private measures of rents, right? You take something like Apartment List or CoreLogic, Zillow, all of that. All of these indices are showing a deceleration in rents, right? You take Apartment List by itself. Rents were going up 18%, from the previous year back in November of 2021. Now it's, as of September, the latest data that we have, it's up 7.5%. So it's gone from 18% to 7.5%. That's a big deceleration. But the official housing, rental inflation data is still going up, as we saw in this September CPI report, right? So the thing is, look, private indices look at just new leases or leases up for renewal, but most leases are not up for renewal each month. So official data, the government's data, they measure all leases, and with good reason, right? Existing and new ones. But because of that, if there's a sharp, rapid increase in market rents, the official data is not going to capture that. And then on top of that, they also average these things over 6 months to smooth things out, which makes sense from a certain standpoint, because you don't want a lot of noise in your data, right? But that smoothing means there's even more lag between what the official data shows and what the private measure shows. And that lag is probably a good 9 to 12 months. We don't know exactly what it is. And I think that's what's throwing off a lot of forecasters too. Like, okay, we know the official data is going to slow down in terms of rents. The question is, when exactly is that going to happen, right? I think it's coming soon, right? Yeah. Now, does soon mean next month or does it mean 2 months from now? Can't say for sure.
Yeah. So again, key concept. Yes, the data comes in hotter than expected, but rents likely are going to start coming down. There'll be more of a, kind of a headwind, if you will, I guess, in a good way for inflation to keep it to stay high, and it should hopefully get inflation a little bit lower. We saw something with medical prices, right, or medical services, something similar, right, where again we want to keep this high level, but there were some calendar quirks, right? That was a big reason why this number came in hotter than expected again, right? But next month you're gonna have major, positives from these medical prices, right? Can you, maybe 30 seconds, keep it simple. Yeah, what happened there?
For the next 12 months, really.
Oh, there you go.
For the next 12 months. So you think with health insurance, right, which is a big piece of medical care, you think, okay, how does the government measure the prices? You look at health insurance premiums, simple enough, right? But the thing is, the quality changes all the time because you may get more or less depending on which health insurance plan you pick up, right? And these things change over time. So to avoid that quality changing issue, the BLS, Bureau of Labor Statistics, looks at something called retained earnings for insurance companies. That's how they measure the price of insurance plans, right? So there's retained earnings, basically the difference between insurance premiums collected and benefits paid out, right? So there's a difference between that. And if it's large, that means health insurance prices are going up. If it's small, that means health insurance prices are shrinking because you're getting more for the same price, right? Now, this data is updated only once a year. Now, in 2020, retained earnings surged because, you're collecting premiums, but they didn't pay out a lot of benefits because a lot of folks made fewer doctor's visits. And if you remember, Ryan, elective surgeries were practically shut down, right? So insurance companies didn't have to pay out all that, right? Now, that data came into CPI. Remember, I'm talking about 2020. That data came into CPI only last October 2021, right? So that sent medical prices for the last 12 months into this September, about 2% up month over month or so, right? Now in 2021, everyone started using a lot more healthcare again. So retained earnings basically fell, it shrunk, right? And because of that, data is going to come into CPI only next month. And it's going to stay there for the next 12 months until we get the next update. So you can see, there's probably a lot of info as to how that CPI sausage is made. But all this to say, look, there's a lot of lag between what the official inflation data shows and what's actually happening in our daily lives.
No,
with respect to the prices we pay.
No, exactly. There's a lot of ways to look at that. Like you said, how the sausage is made. Who would have thought when you listen to the Facts versus Feelings podcast with Brian and Sonu, you would have heard how the sausage is made as it pertains to that particular discussion. I didn't see that coming. Sonu, we've got just a little bit of time left, so we are going to go forward here about kind of some scares of the economy. But before we do it, I was thinking about what really scares me. Yes, these things are legit, these fears, but a couple of things I'm kind of scared of, and maybe you can think of some you are. I don't like sharks, honestly. I don't like sharks, right? Maybe I grew up as a kid watching Jaws, like that donna. That kind of scares me. And electricity scares me because I don't understand it. Every time I mentioned it rained, right? All my Halloween lights went out. That infuriates me because I don't know if I'm not smart enough. I just can't figure out electricity. It scares me a little bit. So those are two things in particular, sharks and electricity. If there's an electric shark out there, I really better hide. What in real life are you scared? Flying, or I don't know. What scares you a little bit?
There is something about some tension when you have to go flip the switch on the fuse box, right? There's a lot of power there, unintended.
Yeah.
But no, I think what scares me, snakes. Goodness, I mean, if you talk about Halloween decorations, and they have those plastic snakes, I'm not getting that. It just terrifies me.
All right, so now I know to mail you a snake. Now I know to mail you a snake for this podcast. I'll say, don't open it until the podcast. I'll have you open it up, and it'll be a snake that pops out live on the podcast. That'll be, you'll probably quit. Yeah, you will be no more. You'll never talk to me again. I won't do that. So anyway, all right. Well, let's take a look. So we're going to kind of talk about the economy right now, but we're going to focus on Jamie Dimon, right? Remember, he came out a couple months ago. I guess he's a CEO. He's the head guy at JP Morgan. I forget the exact title.
He's the CEO of JP Morgan. CEO. And even last week, I think he came out and spooked everyone and said, he sees a recession in, what did he say, 6 to 9 months or so?
6 to 9 months. He talked about the hurricane coming, and the economic hurricane, I should say. And then he came out, but correct me if I'm wrong. I know I'm not, because we said we're going to talk about this. His CFO at the earnings call, you've got the earnings transcript, which is kind of along the lines of what they talk about at a earnings call. His CFO said something a tad different than he was out there talking. Tell me about this, Sonu. This is, I don't know, kind of funny in my opinion, but tell me about this.
So JP Morgan, all these companies that are publicly listed, say in this case, the JP Morgan is one of the largest companies in the S&P 500, let alone our economy, right? So they come on, they release earnings, by the way, which is all good. They beat, expectations on revenue, on earnings per share, as well as net interest margin that was above, what everyone expected. Net interest margin is the difference between what the interest banks earn on their assets, like loans, and the interest they pay out to depositors and other creditors, right? So then they get to, all these earnings calls have a Q&A session, right? So one of the analysts on the call asks the question, I'm going to quote here, right? He says, okay, Jamie, I appreciate all the stuff you said so far, but I think you were quoted in the press talking about a potential for recession in the next 6 to 9 months. I would appreciate any perspective in terms of, are you beginning to see cracks either in commercial real estate, consumer, where you think the economic pain comes from, inflation, higher rates, all of that, right? Would appreciate any insights there. Before Jamie Dimon can answer, his CFO steps in. By the way, Jamie Dimon, I assume, is, the CFO's boss, right? But it's one thing for you to come in and interrupt there. So this is what he said. I'll take that, right? Thank you. The short answer to that question is just no. There you go. And quoting him, continuing that, we just don't see anything that you could realistically describe as a crack in any of our actual credit performance. I made some comments about this in the prepared remarks on the consumer side, but we've done some fairly detailed analysis about different cohorts, early delinquency stuff. And, we do see in some cases tiny increases, but generally in almost all cases, we think that's normalization. And it's even slower than we expect. So then Jamie comes in and like, oh, I need to get in the middle of this, right? This is, I need to sort of correct myself here. He said basically, look, I think I'd say they're in an environment where it's kind of odd, which is a very strong consumer spend. And you see it in our numbers. I'm quoting Jamie Dimon here. You see it in other people's numbers, up 10% prior to last year, up 35% pre-COVID. Balance sheets are very good for consumers. Credit card borrowing is normalizing, not getting worse. So you might see, and that's really good. So you can go into a recession and you've got a very strong consumer. What I would love to ask him is that if you have a strong consumer, what are the odds of going into the recession in the first place?
Yeah. Well, that's a good question. I mean, I guess I'll answer that. It can happen, right? I think, but the good news is if we even do go into a recession, and that's not our base case right now, 6 months from now it could change, but the consumer is quite healthy. Some of those things you just talked about, right? We had a retail sales number come out on Friday, real under the radar because we all were still, I think, kind of hung over from that wild session we had on Thursday. But the headline number missed by a tad. But if you look at X Auto, came in stronger than expected. The control group came in stronger than expected. Real consumption up 1% on an annualized basis, not great, but again, saying the consumer is hanging in there, paying 8, 9, 10% more for most stuff they were buying this time a year ago. If you look at the CPI data, so that's just that's just all part of the pie. I don't know. I can't wrap my head around the fact that he's allowed to go out and say one thing and then someone else on his team says another, and he backtracks. It is what it is. Maybe put a microphone in front of some people. They like to hear themselves think. But the Dimon's obviously much more connected than I am, and that's what really it did spook the market. It spooked investors when he was talking like that. Then you hear what his own company's got to say, and it's a tad different. So interesting. Let's see, what else do we want to talk about here? On the economic front, what else do you think is spooking investors that maybe we shouldn't be so spooked by? Is there something that stands out? Earnings, or I don't know, anything you want to talk about, Sonu, there?
I think speaking of spooky, we just got a Wall Street Journal article over the weekend, and suddenly, these things are spooky, right? Because you open the front page on a Sunday, and the first thing you see is, economists up their odds for a recession, right? But there's a lot that goes on underneath, right? So, the article comes out, and basically they survey about 60-odd economists. And if you average all of their predictions for, probability of a recession over the next year, by the way, over the next 6 to 12 months, it averaged about 63%, right? That's not much better than a coin flip, right? So anyway, I went and looked at the numbers, right? And what are good odds for you? I would say something like 80%, right, Ryan? If you say 80% odds of a recession, you can be, okay, I'm fairly sure there'll be a recession, right? Yep. Out of 58 economists who responded to the survey, only 13 said there are 80% odds of a recession, right? Okay. Just 8 said 90% odds of a recession. And on the other side, 22 of them said recession odds are 50% or below. Coin flip. Right. So that's beyond the headline, right? You look at the headline like, economists up their predictions for a recession. And you're like, wait a minute, they're all over the place.
No, it's not shocking, I guess. I mean, you see some of those things. I mean, it is what it is. Now, one thing I want to talk, one final thing, maybe we like to talk about the Fed around here because the Fed is pulling a lot of levers. Our friends at Pantheon did some amazing research, in my opinion. I didn't know this until this morning, Sonu, but they looked at the last 8 rate hiking cycles. Okay. The Fed stopped, take note, the Fed stopped hiking rates 15 months before. This is a median return, 15 months median, before core inflation rolled over, right? We just saw a new high in core inflation last month. It very likely probably will peak right now. So let's say it did, and they hike in December. That's 3 months after, right? Usually, again, they stop hiking well before inflation is peaked. Now they're doing it up until inflation's peaked. I'll tell you, I'll be honest with you. I see a lot of positives in the stock market, right? But the economy does worry me a little bit. But again, the stock market and the economy are not always jiving. So much bad stuff is priced in the stocks here. Even if we had a mild recession, I think stocks can still do okay. In fact, maybe they can see the light at the end of the tunnel. Maybe the Fed will start finally cutting rates, and that's why stocks can rally. But with the economy, you see the Fed hiking, and they really are hiking until inflation apparently is going to roll over. That spooks me a little bit. I mean, you want to add to that? That was fascinating. Never happened before, at least the last 8 cycles. Hiking after core inflation's rolled over.
I think that's, if you ask me what is the biggest risk right now, and we talked about this when we get a quarterly market outlook webinar, which I think a lot of folks signed up for it. We So the big risk is the Fed tightens too fast, and they've already gone really fast, but too much more as well from here on, right? And what's interesting is, look, I was thinking about this the other day, and we talked about the Fed raising rates, right? What they're raising is just one number, basically, which is called the federal funds rate, right? It's actually the rate for a 24-hour loan that banks charge each other, basically to settle their accounts, right? And then based on them, if they're charging each other more, the theory is that they're going to charge everyone else even more than that because they need to make money, right? Now, it's interesting to think that this one rate is how the Fed tries to control the entire economy, right, and stabilize prices while trying to maximize employment.
They should do it. They should do it on Venmo. They should do something with Venmo. That would slow everything down. As much money as I'm paying everybody with Venmo anymore. Anyway,
no, exactly. And the reality is there are some sectors that are really very interest rate sensitive, like housing, right? Look at mortgage rates, and then nobody's refinancing anymore, right? And but there are other sectors which are not as interest rate sensitive. Right? You look at businesses, and that's where employment comes in, right? Look, when businesses hire someone, that's an investment, right? Are they looking at interest rates to make that investment? Not quite, right? I mean, there may be other investments where interest rates matter. So I think there's a lot of things going on, all this to say, right? And the reality is a lot of the impact of, all these interest rate increases that the Fed has made based on their own models, right? It says the peak impact won't happen for another 2 years, right? So the question is, how, they can't keep ratcheting up. They can't keep, inflation came out too high. Let's increase by another 0.75%. The next number comes up higher. Again, all this is lagging data as well, right? So it's not like what that's actually happening on the ground. They ratchet up even more. So at some point, something will break if they keep doing that. Hopefully, they stop sooner rather than later.
So I am not a doctor. But sometimes they dress up as one is for Halloween. Who knows? But you think of like a patient, right? You give the patient a lot of medicine. Sometimes you stop giving the medicine and you wait for them to get a little bit better. It feels like the Fed's just giving medicine nonstop until the patient gets better. Then they're going to give a little more medicine. So again, we'll just see, right? I mean, the credit, again, let's summarize it like this. I said that what JP Morgan said. The credit markets are still working. They're still functioning. We are not seeing massive cracks or worries from the credit markets, high yield spread, investment grade corporate spreads. Those are still hanging in there and in fact improving in a lot of cases. That's a good thing. That's to be the smartest guys in the room. So until we see more cracking there, then I'll start to worry more about the overall economy. But I'll tell you, the stuff the Fed is doing, I hate to be like, the Fed this, the Fed that, but the Fed does pull a lot of levers. That worries me. So Sonu, we've hit the end of the road. Any final comments, anything you're watching, anything else you thought of that might scare you, or anything else you want to say to the listeners before I bring us home?
I think, look, there's a long way to go. Well, the November Fed meeting is coming up, first week of November. There's an election in there. We're going to talk about the election, by the way, right? And the December meeting is going to be where I think things get interesting because we have 2 more inflation reports before that. We have a couple of employment reports before that. So, I think there's a long way to go, even though it's only 2 months. There's a long way to go in terms of the data that's coming out. That's going to shift expectations, all of that. So a lot to watch for, really. And good seasonality too for markets, right?
Oh yeah, we're entering some of the best seasonality time frames this quarter into the next quarter. So and we think we're making a low probably or trying to carve out one. So that's a positive thing. Hopefully people keep listening to this podcast. There's a lot of things going on out there. We're going to do our very best job within a half hour or so once a week to kind of slice and dice it and show what we're seeing on the Carson Group's Facts versus Feelings podcast with Ryan and Sonu. So I'll just bring us home, guys. Thank you again. This was our 6th episode. We're having a lot of fun doing this. Join us next time for the 7th episode, obviously. And if you like it, give us a like, give us a follow, give us a positive review wherever you can, wherever you get this podcast. We really appreciate it. We're going to keep on doing it. So again, Halloween is not far away, so start thinking about your costumes. We'll see everybody next week. Take care. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results.
All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.